Hi everyone, so welcome to Investing for Value. So today we're going to do Cardlytics. Like, why is it dropping? Is it dropping because the results that were recently released were really bad, or is it a really bad reaction? So share price has dropped 36.7%, which is a large amount. Like, you would have to think something really bad happened to this company to drop that much. So let's kind of like dive in and check out what went really bad. Because like, yeah, if you look at how the share price was before the drop, it was like $86. So yeah, something really bad happened. And previously, even in last month, the share price was well over $100. So to be trading at $54.55, something just, something's happened. People are kind of wondering what happened. Well, the main thing that everyone just looks at and they don't know what happened because no one's really diving into the financials yet. Well, the CEO just recently resigned, so he's going to take a position in the executive board as the executive chairman, and everyone below him is going to move up. So there's two co-founders, and one co-founder who's the CEO is moving to executive board chairman, and the other one's moving from I think the CFO into the CEO position. So even though one co-founder's gone upwards, another one's come in. Um, so you still have like co-founder led company, but you must be wondering, it couldn't be this simple. It couldn't be like a CEO leaves and things drop like crazy. You'll be right in coming to that hunch. So let's look at their financials and let's do a little bit of deductive reasoning. So like financials, they don't look too bad because like you look at 2017 and it was 130 million in terms of revenue, and they proceeded to go higher to 150 in 2018. So things do look a bit more normal, and that was like a 15% increase. So I want you to remember these figures as we go. So from 130 then to 150, and it was a 15% increase. And then now we go from 200, then we went to 150 to 210 million, and that's a 40% increase. So you've gone from 15% to a 40% increase, which is like, in a sense, it's like unusual. You usually see companies grow really quick in the early stages, and as time passes and as they try to grow larger revenues, the growth rate actually drops off. So that's kind of a thing. Growth rate tends to drop off as things go. But they went 15% to 40%. So that kind of made the share price go really high because people all of a sudden expected this company to just start producing all these amazing results, which they kind of have. So it's not necessarily like a bad thing that if the company all of a sudden put out a guidance, which they put out a guidance that said their first quarter, so they didn't really give like a guidance for the full year, but they gave guidance for the first quarter of 2020, and it was 43 to 46.5 million. So the prior first quarter of 2019 was 36 million. So you look at the current guidance, and the it's a 20% growth. So if we come back to here, but that's just the first quarter, mind you. Like first quarter, it could just be slower, and then things get a pick up a bit more as time goes. But overall, it's kind of a sign that growth is going to slow down. So you might look at this and go, okay, they grew at 15%, then 40%, and now they're adjusting that 40% back to like 20%, or maybe they get a bit higher as the year goes. But generally, it seems like the revenue growth rate is kind of slowed down a bit again. So if you look at a growth company and share price doesn't do well while the results are good, like looking at this, the results are good. So you can't say they are not good, but usual case is the guidance is usually the problem. And as you can see, like they were profitable for the fourth quarter. They earned 3.4 million in terms of the accounting standard, and if you go up to like where was this? Up here, the non-GAAP, without the accounting standard, it was about 5.2 million, which isn't too bad. Especially when you consider that this company in 2018, in the same period, for that same quarter, was losing 11 million. And then you consider for the full year, they lost 17 million, and then you look at 2018, and it was 53 million. So when you look at the progress this company's made, okay, sure, they lost, they're still losing money, but in terms of an accounting standard, we're going to look at the cash flows afterwards, and then you're going to be thinking, okay, well, things actually aren't that bad compared to how things are looking. They look, the cash flow statement looks way better than this. Like, last year they lost 53 million, this year they lost 17 million. So if we go to like the cash flows area side of things, um, their cash flow actually increased on a positive basis by 11 million, which is really good. And in last year it was about 19 million negative last year. So you're looking at this company that's making this transition from losing a lot of money to being more positive. And of course, yeah, like this, their growth slowed down, which was probably like very disappointing to shareholders. But is it disappointing enough to justify like a massive 36% drop? But at a 36% drop, you still have a company worth 1.4 billion, and you must be wondering, is it worth 1.4 billion? Which is the big question. Well, like from my point of view, like I think it's definitely like worth this much. Maybe the pricing was previously a little high, given that we have to readjust things. If growth rates drop, we have to revalue the company according to the new growth rates. If we assume, like I think the company was assuming that they would probably grow at around about, uh, I think like between 26 to like 37%. I think that was some figures that was tossed around. Um, and then, yeah, like potentially if they grow at those rates, it's lower than the 40% that they've been growing last year. But like you just have to look at the performance of this company. It's not one of those companies that has been growing at a linear rate. Like if 2007 to 2008 was a higher growth rate, and then it drops here, maybe like you can see like a declining trend, but here it was only 15% growth rate, and then here it jumps to 40%. And you can't blame the company just to go like, oh, previously we were making a lot of losses in an accounting sense, and then now we're looking at cash flow positive because last quarter was profitable, and we want to be a more profitable company going forward. You can't blame a company for wanting to just steady the ship first before they start to really chase more growth. And you got to look at this company as like this company is a company that does reward programs, and then it gets a lot of data and it sells that data off to marketing companies, and then it makes quite a lot of money off that. And you can kind of see this being as one of those really strong futuristic type companies where in the future it's all about data. Like this isn't a company that you buy because you really see like a future in the next 6 to 12 months. This is a company where you see a future in them in the next 5 to 10 years, and you don't mind holding for a long run. Like if the price dropped and you really like this company and you're willing to hold for the long run, then it's a good time to be buying. It's definitely quite an overreaction, particularly how things are going. That you just have to look at your own situation and you go like, am I here for the long run or am I not? Am I here just to, well, were you here just for the results, and then when the results did well, the share price popped and you got out? Or were you here for the long run? If you're here for the long run, then yes, it's a good situation to be like buying at a low price, because it's kind of like a low reaction, like it's a big reaction for like something where, yeah, sure, your growth rate dropped, but this is a company that's going to be able to consistently grow. Maybe not consistently. Like Maybe the rate of growth isn't going to be consistent, but the growth will be consistent. Like you can guarantee in the future that this company is going to have more revenues than it has currently, and that's the strong selling proposition of this company. You're not buying this company because it's doing something really innovative, in a sense of like it's selling products. No, it's selling data. It's selling data, and this data is going to be very valuable, regardless of most situations. Um, and you can kind of see them, just being relevant for a really long length of time because they're, at the end of the day, they are, this is a company that other marketing companies will always be coming to. They'll always be wanting data because having data is about making smart decisions. It's about being able to advertise to someone and knowing that the likelihood that they would be perceptive to this advertising is high. Like whereas in previous times, take it back like a decade or two, someone would just come with a creative idea and just hoped it worked. These days, they can really target the audience. They know what the audience likes. So so this data, it makes it much more efficient in terms of a marketing perspective, and this company largely benefits of it. And yeah, the revenue's dropped off, but this isn't a product that you scale really quickly because it only scales as quick as the amount of people you can find to want to buy your data. And there's always going to be people that want to, and you're always going to have a very competitive, advantage. You can always charge a bit more. So as you go on, like this is kind of like one of those situations where it's an inflationary proof situation where this company can charge what they like. And companies are really willing to pay for this data. So yeah, like it dropped 30%, 6%. Yep. Its growth rate has dropped, so I guess in a way it's justified to an extent. But yeah, like, I don't see it like being one of those situations you consider. It's not a very linear type company. It's not like a company that goes, I produce this many goods, and if I, keep selling them, then yeah, I'll have a certain growth rate. But the minute my growth rate slows, it means there's less customers that really want my product. And yeah, maybe less customers want the data, but there's always going to be someone that wants the data. So the moat around this company is massive in terms of the data situation. This isn't just an ordinary company, whereas kind of like people are kind of the reaction looks values it like an ordinary company, but in reality, this isn't an ordinary company. This is a company that if you hold on to in the long run, it's going to be worth significantly more than it is right now, and that's the kind of value proposition you want to go for, particularly if you're going for a long run situation. But if you're going for a short term, it's very difficult to price these things to say, oh, you're gonna buy it and in hope the share price pops comes back by 5 to 10%, and then you end up selling afterwards. Like if you're here for the short term, I can't advise you because short term wise, it's like if I was to really critically judge this company and go, oh, you just dropped your growth rate, our thing's not doing well. Your CEO just resigned to take a higher position. That's fine. But, we could look at it being like, oh, you just lost a very fundamental member who was running the ship and now you have something new and we don't know what that new person is going to be like. We could look at that situation. But in reality, you can only really consider this company if you're here in the long term. If you're here for the long term, then yeah, it's a good company to get a position into because of the really, really strong moat. And it's also a company that's beginning to be very profitable. So previously, you had a company that had a lot of losses, and also here you can kind of see like 2017, 17 million losses, 2018, 40 million losses. And then you have, 2019, 17 million losses. Operating losses anyway. But if we come down here, yeah, it's a very similar situation. So yeah, like you can see, it's yeah, like this is a company that basically, yeah, like they can spend a lot of money to grow, or they can slow it down, stable the ship, and then they can always grow in the future. At the end of the day, this is like a valuable product that this company has, and there's only going to be more stronger demand in the future as time goes when people realize how important data is. Like people realize how important data is right now, but it's a question of, are you here for the long run or are you here for the short run? If you're here for the short run, don't worry, company takes care of itself. If you like long run, yeah, if you're here for long run, yeah. But yeah, if you're here for short run, yeah, like it's very hard to just advise on a short run perspective. But long run, yeah, long run, I could say you'd be fine. Short run, you just have to make a decision whether you wait longer or not. If you're only buying for the short run, maybe you should reconsider because it's just as the results kind of prove, this is a company that isn't that consistent about how they want to grow, and the product they sell isn't that consistent because the data, sometimes you have people interested, sometimes you don't, and the fact that they're constantly, able to keep growing shows that there is a big demand for the data. But of course, it's going to be very lumpy. Like products like this, that there's not like if you're not selling to an average consumer, generally product revenues are going to be very lumpy, and that's the reality of things. Yeah, like that's just yeah, and that's my opinion and how I interpret things anyway. Yeah, like you can always let me know how you interpret this data, if you kind of see this as being justified or unjustified, or if you have any other companies, just let me know. Always interested to look at them. Until then,